Hello there, and a very warm welcome. Today, we're diving into a topic that's, well, absolutely crucial for any business owner. With this guide from the experts at My Tax Accountant, we're going to walk through what happens when it's time to close the doors. You've put in years of hard work, so getting this final step right, it's everything.
And honestly, that is no exaggeration at all. We're talking about the difference between a really smart, tax-savvy closure and a mistake that could literally cost you thousands, potentially tens of thousands of pounds just left on the table. Or even worse, a surprise bill from HMRC that you really don't want. And that's exactly why we're so glad to have this guide from My Tax Accountant. It is completely up to date for the 2025-26 tax year, and it's been designed to cut through the jargon and just give you a clear path, making sure you can close your business in the most tax-efficient way possible. So, here's what we're going to cover. We'll kick off with the first steps everyone needs to take. Then, we'll look at the specific journey for sole traders, and after that, how to dissolve a partnership. From there, we'll get into the really high-stakes world of closing a limited company, and we'll zero in on the smartest way to do it. And then, of course, we'll wrap up with your next steps. Let's get right into it.
Okay, first things first. It doesn't matter what kind of business you run, whether you're flying solo, you're in a partnership, or you've got a limited company. Your very first official move when closing down is telling HMRC. You've got to let the tax man know. And this isn't just being polite, it's a legal must-do that kicks the whole process off.
And here is a pro tip you need to write down. You have a strict 3-month window from the day you stop trading to tell HMRC. If you miss that deadline, they can start hitting you with penalties and they stack up fast. We're talking up to 100 quid a month. Trust me, this is one day you do not want to let slip by. Right, let's now turn to the most common type of business here in the UK, the sole trader. So if you're a freelancer, a contractor, or you run a small local business all by yourself, listen up. The good news is the whole process is actually very manageable, as long as you follow the steps in the right order. So the key is to work through this checklist. Let's picture Sarah, a freelance graphic designer based in London. First, she picks her final trading day and lets all her clients know. Then she gets online and officially tells HMRC. If she's registered for VAT, she has to deregister. Next up is her final self-assessment tax return. She'll also need to figure out if she owes any tax on assets she sells, like her fancy work computer. And finally, she just needs to square away her national insurance. See? It's a clear step-by-step path. And here is a key number for you. For the 2025/26 tax year, this is your capital gains tax annual exemption. So what does that actually mean? Well, it means when Sarah sells off her business assets, she can make up to £3,000 of profit on them before a single penny of tax is due. It's a small but really useful tax-free bit of breathing room that every sole trader should know about. Now, if you're dissolving a partnership, things get a little bit more complex. As you can see from this table, there are some key differences. A sole trader can just hop online to notify HMRC, but a partnership, you need to send a formal letter. And this is the big one. You've got the main partnership tax return to do, plus each partner has to file their own individual self-assessment. This is where having a solid partnership agreement is absolutely vital because it spells out exactly how profits and any capital gains are split. Without one, this stage can get very messy. All right, let's move on to limited companies. Now, this is where planning really pays off. If your company is solvent, which just means it has enough money to pay all its debts, you've basically got 2 main ways to close it down and get the money out. And the choice you make right here, it can have a massive impact on your final tax bill. Let's put them side by side. You've got the strike-off. It's simple, it's cheap, but any cash you take out gets taxed as income, just like a dividend. Then you have the Members Voluntary Liquidation, or MVL. It's a bit more formal, but here's the kicker. The money you take out is treated as a capital gain. So what's the magic number? It's this, £25,000. If your company has more than 25 grand in assets, an MVL is almost always going to be the better option because tax rates on capital gains are way lower than on income. And here's why that choice is so unbelievably important. Let's say you're a higher rate taxpayer and you take £50,000 out of your company using a strike-off. That's taxed as a dividend at 33.75%. Ouch. But if you'd used an MVL and you qualified for the right relief, it would be a capital gain and your tax rate could be just 10%. The difference in tax you pay is nearly £12,000. I mean, think about that. That's a family holiday, a new car deposit, gone, just by picking the wrong process. So let's really dive into this tax-smart exit. The MVL is, without a doubt, the gold standard for closing a successful small company and getting its value out efficiently. Now stay with me here. This next part could genuinely save you tens of thousands of pounds.
This right here, this is the number you need to remember. 10%. With something called Business Asset Disposal Relief, or BADGER for short, the capital gains tax you pay on the funds you take out of your company via an MVL can be as low as just 10%. Now compare that to dividend tax rates, which can climb as high as 39.35%, and you can immediately see why this is such a powerful tool.
Now, the whole process might sound a bit intimidating, but honestly, it breaks down into 4 quite clear stages. First, the directors have to make a formal declaration that the company is solvent. Second, you appoint a licensed professional, an insolvency practitioner, to handle everything. Third, they distribute all the company's cash and assets to you, the shareholder. And finally, they're the ones who handle all the final paperwork with HMRC and Companies House. Now hang on, not everyone gets that amazing 10% rate. To qualify for business asset disposal relief, you generally need to tick these boxes. Your company needs to have more than 25,000 pounds in reserves, though really it's most cost-effective if you're over 35,000 pounds because you have to pay for the professional fees. The company must have been actively trading for at least 2 years. You need to be at least a 5% shareholder and also an employee or director. And this last one is critical. You can't be planning to start a very similar business right after you close this one.
And that last point is so important. HMRC brought in a special rule to stop people from closing a company, taking all the profits out at that lovely low tax rate, only to open an almost identical one the very next day. This is called phoenixing, and if HMRC thinks that's what you're doing, they can just cancel that tax benefit and charge you as if you just paid yourself one giant dividend after all.
But that's not all. Here's where a lot of people can go wrong. Even if you have the perfect plan, there are these common traps, these little banana skins that can catch you out at the very last minute. So let's cover the main ones you need to avoid.
Okay, these are 4 of the costliest mistakes we see. First, an overdrawn director's loan. If you owe the company money, that needs to be sorted before you start, or it can trigger a huge tax charge. Second, getting the final VAT return wrong is really common. Third, people forget about the 13.8% employer's national insurance on any final salaries. And then there's the most shocking one, bona vacantia. It's Latin for ownerless goods. And it means if you don't transfer every single asset out of the company before it's dissolved, even a forgotten bank account with a tenner in it, it legally passes directly to the Crown. Gone.
Whew. We have covered a lot of ground, haven't we? From that first crucial notification to HMRC, all the way to some pretty complex tax strategies. So let's just pull all of that together, look at the key takeaways, and figure out what you should do next. Okay, so to recap the absolute must-knows. Number 1, do not miss that 3-month HMRC deadline. Number 2, if you're a sole trader or in a partnership, your main jobs are the final tax return and capital gains. Number 3, for a limited company with over 25 grand in assets, an MVL is your new best friend. It can slash your tax rate to just 10%. And finally, planning is everything to make sure you don't fall into one of those costly last-minute traps. Look, it is completely understandable if all of this feels like a bit much. Closing a business you've poured your heart into is a massive deal, both emotionally and financially. But the good news is, you absolutely do not have to try and figure all this out by yourself.
So this is really the final question you need to ask. After all of those years, all the long hours, all the dedication, isn't it vital to make sure you take this last step correctly to protect every penny of the value you've worked so hard to create?
For professional help that's tailored exactly to your business and your situation, you should get in touch with My Tax Accountant. You can give them a call on +44 0208 570 8531, or you can drop them an email at info@mytaxaccountant.co.uk. They can help with everything we've talked about today and a whole lot more. And for more really clear, practical guides just like this one, make sure you subscribe to their YouTube channel. Thanks so much for joining me.